You're listening to a CNA podcast.
Hey, it's Andrea Heng, and this is the Money Talks podcast. Today, we'll be talking about a different kind of investment that you may want to include in your portfolio this year. They're called REITs, or Real Estate Investment Trusts. Heard of them, but don't know what exactly they are? Well, as always, this is the podcast to break it down for you. But before we get to that, let's talk about some quick financial headlines with my editor, Tiffany Ang, here in the studio joining me.
Hey, Andrea.
Hey.
Well, first piece of news that caught my eye this week. Anti-scam money locking features have been activated on about 38,000 bank accounts here.
Wow, that's a pretty big take-up.
Yeah, so last November, DBS, OCBC, UOB, the three big banks here, rolled out this feature. Well, you can only unlock in person at bank branches. Well, the whole idea is essentially you're just trying to prevent scammers from taking all of your money away.
Yes. Don't let them touch it. Nuh-uh. Okay, wait. So if I lock these funds up, that means I can't be using them to invest or move the money around. Am I getting this right?
Yep. So the straight answer is yes, you can't invest or move that money around.
Okay.
But it won't be sitting, over there doing nothing because the banks actually incentivize you with interest rates.
So this is actually pretty similar to a fixed deposit.
Well, some people do see it that way, but the whole idea is that if you think your life savings may be wiped out in a flash, then you can activate this feature and lock away some funds.
I mean, that's a plus to me, a double plus to me. So I would do it if I thought I was vulnerable. So that's something to think about while we're doing our financial planning. Meantime, some other related bank news. Maybank Singapore has become the first foreign bank to offer fixed deposit for CPF funds from the ordinary account. We know how hard it is to touch this.
Yeah, so you might be asking, why would you want to put your CPF funds in a fixed deposit?
Yeah.
When it earns a pretty decent interest if you leave it with CPF, right?
Yeah.
Okay, here's what you need to know. The OA, or ordinary account interest rate, is 2.5% per annum, while this fixed deposit is offering 2.9%.
But that's provided, though, that you don't think you can get better returns with your OA, right?
Exactly. So there are other instruments that you can use to invest your OA for retirement. So for example, T-bills.
Right.
We've talked about that on this podcast before, right? But the interest rate also fluctuates there.
That's the thing to keep in mind. So it is important, as always, to do your homework. And of course, if you are thinking of putting your CPF funds in a fixed deposit account, remember, you have to first set aside 20,000 in that OA and 40,000 in your SA, your special account, before you move any of that to any other location, financially or otherwise. Hope we've given you some food for thought today. I bet you've heard of REITs, short for Real Estate Investment Trusts. But do you really know how it works and why it's such a hot investment option for some people? That is what we're going to talk about today. What are REITs? How do they work? Are they a must-have in everyone's portfolio? With me today is Gabriel Yap, Executive Chairman of GCP Global at GCP Holdings. Welcome to Money Talks, Gabriel.
Thanks for having me, Andrea. Happy New Year.
Happy New Year.
And to your audience too.
Yes, thank you very much for that. It's such a pleasure to have you on the podcast. First and foremost, give us a 101 on what REITs are.
Well, REITs is as simple as ABC. It is real estate that you really can trust.
Okay.
Simply because the REITs are actually prevalent in 43 jurisdictions right now, out of 193 countries. And in the last 5 years alone, China has come out with REITs, India has come out with REITs, Philippines has come out with REITs, Sri Lanka has come out with REITs. It only goes to show that it's a very good and great way for real estate developers, property owners to recycle the capital into their capital markets. And if you speak to many of the exchanges that actually host this kind of REITs, they are very welcoming because one, it actually adds depth to the markets that they are actually in. And secondly, it sort of like enliven a new kind of industry within the markets itself. But generally, all the laws are similar in the sense that because you own the real estate under the investment structure that's under REITs, there is therefore, in order not to pay tax, you at least have to pass through 90% of the income that's earned by the REITs
Right.
to the unit shareholders then.
I see.
Simple as that.
Okay. It's a very interesting instrument, I have to say. When we think about investing in real estate, we often think about investing in our homes, that sort of stuff. We don't always think about REITs, commercial trusts and office buildings, that sort of stuff, right? So can you just explain to me how exactly REITs work? For example, what's the objective of having a REIT?
I think the whole idea is actually, other than deepening in the capital markets, it's very clear that REITs actually cater to conservative investors but want a real estate element in
Right.
their investment portfolio, in their investment strategy. Well, as a matter of fact, if you do and study all the wealth surveys and reports that's been dished out in the last couple of decades, it is clear that particularly among Asian investors, a very high element of wealth is actually parked under real estate. The biggest problem previously was that because it is a chunk of real estate for which they are normally leveraged, because, for example, in expensive countries like South Korea, Singapore, Hong Kong, the moment you actually buy real estate, you need to actually undertake bank loans, which
Right.
actually is not a good idea. So what the real estate investment trust is that they actually securitize, that means they break down each of the units so that unit shareholders own a fraction of the real estate.
Got it.
Yeah.
Okay.
So this actually enables the investor, therefore, to number one, earn good income, two, participate in various sectors, because you really don't want to be just overly exposed to one particular sector. So it actually, in Singapore context, we actually have real estate investment trusts across property types like retail, industrial, data centers, hospitals, but in more developed markets, for example, like in Holland, in the US,
Right.
in Australia, we actually have real estate in lodging, in timber, in single housing, in multiple family housing.
So you're saying that by investing in a REIT, I am able to invest in real estate without necessarily the overheads required to actually buy a piece of real estate.
Precisely.
Okay, I'm glad I got that clear. So that leads me to my next question then. Do REITs actually affect or have an impact on real estate market prices? Is there a link there?
Not really. It's the other way around, Andrea, because it's the real estate, the underlying real estate that makes up the REITs. The fortunes of the real estate market goes up and down.
Right.
And therefore, they actually impact the REIT prices. See, so for investors, there are always two sides of the thing. One is that you are actually buying exposure to real estate, but you must be cognizant of what happened in the real estate market. So, for
Right.
example, you want to stay out of US office market right now because there is great fire sales, salvage sales within the US office sector. But at the same time, because it is a real estate investment trust listed on a listed bourse or exchange, then the other parameters of valuation, for example, like interest rates that affect any kind of common equity or bonds, do actually have an impact on real estate investment trusts as well.
I'm glad you brought that up because I wanted to ask you about how interest rates have an impact on REITs.
When it comes to real estate investment trusts, just be the opposite of real estate, just be the opposite of interest rates. When interest rates go up, you can see that real estate will be hit. If you can, minimize your exposure. And we are talking not just on the last interest rates increase, where it started on 17th of March last year, right up to, we hope that the bottom has already been seen.
Fingers
on
crossed.
26th of October 2023.
I wanted to ask you, are fund managers the only way for us to invest in a REIT?
Oh no, the beauty about REITs is that many individuals are even smarter and faster and better investors than fund managers.
Wow, okay.
I mean, there are a couple of reasons. One is the fact that in terms of size, as an individual, you can just buy according to your appetite
of course.
or your wealth. So there's no necessity to just leverage to actually take big positions unless you're absolutely sure that certain things is going to go up by a certain amount in a specific period of time. If not, there are 38 REITs in Singapore that you get a very good diversified exposure in the various sectors. And the beauty is that not all sectors, for example, the office doesn't move in line or in sync with the industrial market.
Right.
It could be two different submarkets altogether. So that also allows the individual to be arbitraging it very quickly.
Right.
So that's why one of the hallmark of a good, successful investor is to be able to actually read the trend. You must always look at catalysts and things before they turn, not after they turn, because the bulk of money is always made at the turning point of REITs up cycles. Has always been the beginning.
So you don't necessarily have to have a very long foresight. You just need to be attuned to what's happening, look out for that turning point, and then say, okay, this is the time where the tables are going to turn. I have to do something with my REIT investment.
Yes, indeed. When it comes to the long-term trend, it's pretty evident. I mean, REITs, the prices, and they move according to real estate market in the underlying areas that they invest in. So, for example, if cap rates actually move down, the real estate prices that's underlying the REITs will go up. So if you can preempt that, that would be great. Secondly is that you always want to position before interest rates go down, because when they go down, that's where REIT prices actually move up.
Could you break that down to even simpler terms to someone like me who is saying, okay, I'm ready to invest in a REIT. How does it work for me? What happens with what I put in?
So when conditions are ripe and right, in the sense that interest rates are falling, that is a position that most people want to trade in. The second aspect of REIT is the beauty of just, if you don't want to do anything, just sit there. Because every half year, every quarterly, they will pay you dividends. And REITs dividends as an asset class in Singapore, in the last 21 years, they have actually paid the dividend of as low as 5.5%, right up to as high as 14% during the global financial crisis.
Right.
So you want to earn this kind of return, if a fixed deposit paying you 3.2 to 3.5%, government bonds, so you get a better uplift in that.
And what about those who are retail investors, individual investors such as myself? Where do we stand in making the right choices when it comes to investing in REITs?
Right. I think, unfortunately, in the when it comes to retail investors' track record in Singapore, particularly on real estate investment trusts, it hasn't been that fabulous, particularly in the last 2 years.
All
I know
right.
for those who are caught in the downdraft of beaten down stocks like Manulife REIT, Prime REIT, Capital Oud, Lipo Malls, Elite Commercial Trusts, you notice that, well, you'll be hard put to actually ask yourself, when will your stock recover? Now, even if this respective stocks recover 50% from the current levels, you're not even seeing the same levels that you saw before interest rates start to come down last year. That was in 17th of March last year. So therefore, that means that a lot of money has been lost. In fact, when Eagle Hospitality Trust went under, well, that was a case where it was the first REIT in Singapore that basically crashed. I think a lot of investors lost money on that perspective. So on hindsight, you'll be asking what kind of lessons that you want to learn. So I think at the end of the day, it's very important to know what we call known the unknown. So if you are clear that this particular REIT has no role in your portfolio whatsoever because of the high risk affinity,
Got it.
or for the kind of underlying real assets that they own that maybe do not fit your risk profile, then that's
Right.
the first thing you want to exit or don't even want to touch. You see.
Right,
Yeah.
right. Okay, that's really useful. Also, I wanted to ask, is there a difference in the risk profile of retail REITs versus hospitality REITs versus lodging REITs? Or are they just market sensitive and you just have to know and watch what happens in those various spaces?
Well, generally in all spaces, be it industrial, data center, office, it boils down to a couple of things. One is actually demand and supply on the underlying real estate. So, for example, in Singapore, the forecast for the next 3 years between now, 2024 to 2026, for new retail space coming up is only 1.3 million square feet over the last 3 years.
Well, we are
So-
very land-starved space
Yeah,
overall.
so if you average that, that's like 300 to 400,000 new supply this year, next year, and the following year. And then you look at the historical 10-year average of supply, it's like 800,000 per year. So this is like a big drop. So, and we reckon that, well, in places like Singapore, if the rain continues to be so heavy, or suddenly the sun comes out and you don't want to go out too much because it's too humid, you probably park yourself in the malls. And if you look at some of the new brands that come up in the malls,
Yeah.
among the first floor levels, and new brands normally comes in and pay very high fees. So examples would be your pop-up
Yeah.
tar areas. They do take up not very big a space, maybe 60
But
square
they're
feet.
still prime.
Yeah, but they pay huge prime rentals. you see. So
Yeah.
in that perspective, if that space or that shopping area is owned by the REIT, then essentially that is a great proposition then.
Okay. So I wanted to talk now about how REITs have been performing, historically speaking, and not too far back in history, just talking about 2023.
Right.
It didn't seem like a good year for REITs. So now that we're in 2024, what would I need to know if I do want to consider REITs in my investment portfolio?
Right. I think there are just two things you really need to know. So the first one is the macro factor. So the macro factor is very clearly the fortune of the REIT sector that you're investing in. So if you reckon that, well, earlier we talked about the retail space. Let's say if you take a view that data center is going to be a great sector to be in because of the move towards artificial intelligence, the number of hyperscalers from your Facebook, Google opening data centers in Singapore, then you notice that this is a sector to be in. So that's the kind of macro factor there. But again, the same macro factors may change. So they are regulated, so you need to watch that closely. So and on the macro front, you also want to look at interest rates movement, when and to what extent the Federal Reserve cuts interest rates, how soon, how fast. The CME Market Watch tool, are they actually saying that, well, the market consensus is 64% that their first rate cut is going to be in March. But if that's delayed, then of course that will become the underlying linchpin for volatility within rates. Now, the second factor that you want to be very cognizant of is the micro factors affecting the REIT. So example would be how the management has been preparing the balance sheet of the REIT.
See, yes.
Yeah, so like in life, if you actually prepare yourself well to be healthy, you don't eat too much, make sure you go on the right diet, do the right side kind of exercise, you sleep well, don't drink too much alcohol or smoke, I think you're in a very good position to be in good shape all the time. So similarly, for the same thing, if you are cognizance of the workings of each particular REIT, the capital structure, the gearing ratio, the interest cover, and what is the projected increase when they're actually paying back their debts.
And I think it's really a good time as any in this conversation to point out just how sensitive REITs can be.
Indeed.
And you need to be the kind of investor that can stomach this kind of market movements. You need to be the kind of investor that is very well aware of what's happening and very attuned to what the specific factors are. International REITs versus S-REITs, which stands for, of course, Singapore REITs.
Right.
What are the biggest differences, especially in terms of the risk-reward?
Well, first and foremost, the foreign REITs listed in Singapore in the last 2 years has been really bad for them. In fact, none of the REITs with foreign assets listed in Singapore and coming to the market after 2013 have actually made money for investors or have lost money.
Why is that?
So one is actually the IPO price that they actually came in. Well, at GCP Global, we already warned investors that they were too high. Second, I think investors will want and need to see the track record of delivery at the DPU level, that is the dividend per share per unit growth that underlies the performance of the share price.
Right.
So if indeed the managers cannot deliver on that, then you'll find it's very difficult. Because in the earlier years, it was much easier because when interest rates was near to zero, all you need to do is actually just borrow, because the REIT's mandate is that you can borrow up to 40% under the MAS regulation. That obviously now you can do up to 50% because the LTV ratio has actually changed to 50%.
Right.
You know,
And that's
so
where Singapore REITs have the advantage then.
in that sense, playing with the regulations, yes. But the problem is that the overseas REITs that were listed then, listing in Singapore, so for example, if you are a US REIT, you are getting your revenue and NPI in US dollar. So in the last 2 years alone, the US dollar has crashed from 142 down to 133 against the Singapore dollar. So when you actually get your payments or DPU in Singapore dollar, then of course it will be lesser.
Yeah, you're going to lose out.
Yes, of course you will still get the payment in US dollar, but if you convert back for a retail
It's the
investor,
value, right? The currency
correct,
value.
Correct. Yeah. So the same
Understood.
case is for the British pound. Yeah, the same case for the euro in that perspective.
Right. What about foreign REITs listed elsewhere? Are we privy to investing in that? And what sort of considerations do we have to make when it comes to risk-reward investing in overseas REITs?
Right. When it comes to overseas REITs, it's a very interesting ballgame. I'll give you an example. During when full pandemic hit, and then everybody thought that it was like all hell break loose. But,
Yeah, I sure felt that way.
But in reality, there wasn't one particular sector in the REIT market that's actually the timber REITs in the US that shot up like almost double. We actually dabbled in that and invested in that, but we were quick to actually exit after an 80% gain in a very short period of time. That was because it was clear then that because you need to work from home,
Yes.
the amount of construction would not be able to catch up the underlying demand, simply because nobody can go out and work at a time. So hence the reason for timber stocks and timber REITs to actually shoot up. You see. So
Right.
you can have this kind of phenomena happening in the real estate
That's
investment market.
fascinating.
Yeah, and that just underlying beauty, because in the other markets like Europe, some of the more traditional markets like Belgium or Netherlands have one of the longest, more entrenched REIT market. You actually have exposure to other sectors. That is actually, you can even buy REITs that own ski resorts, for example.
Wow.
Yeah, so you take a bet that
That's
if,
really diverse.
yeah. So if you take, for example, because of climate change these days, if the winter is going to last longer, you get more wintry powder for the snow, then of course, go buy this kind of REITs. If not, then of course, it can work both ways. So it depends on your bet, your ability to read this. So it's very important, therefore, to be a very smart and sharp investor all the time.
Yeah. I think if you think about it in a certain way, if you have the right kind of risk profile and appetite, this can actually be fun.
Oh, it is. I've been doing it since when I always tell my wife that during college days when my friends were chasing girls, I was already chasing stocks. So that was in the 70s and 80s. So right now I'm approaching 60 years old. So I'm still chasing the same stocks, except there's different price levels with good profits to be made.
Wow, that's a lesson to be learned here. So moving ahead, what's your outlook for S-REITs in 2024? Considering, of course, interest rates are likely to come down. We don't know when yet. Does that mean then that S-REITs are going to come back up?
We reckon that the lows for this down cycle has been seen. After all, in a normal correction basis, in the REITs in Singapore, at least in the last 2 interest rate cycles, actually took an average of about correction of 9 to 11 months. This time around, considering the fact that the Fed started to increase interest rates only on 17th of March 2022 and then bottoming on 26th of October 2023. That's over a span of 21 months. So by far, in terms of a normal correction, it is already the longest. And secondly, in terms of magnitude, if you take the REIT benchmark closer to 900 and closer to 600 in the October that we saw, that's almost a 30% drop. So the only time when the REIT market suffered this big was a 74% drop during the global financial crisis in 2008 and 2009. So this time around, ironically, we are in this situation because GDP is too good. Inflation is too high, meaning that the economy is growing too fast.
Exactly.
So,
now we're in a case where there's too much money.
Correct. So we reckon that this year it's going to be a good year for real estate investment trust. This will come close to what we saw in 2019 after the last Fed increase stopped.
So pre-pandemic levels.
20th, in fact, after the last interest rate hike, that peaked on 20th December 2018. So beginning January of 2019, the REIT market was just up and up. Until 14 months later, that means to be exact, up to 19th of February 2020. 5 days after Valentine's Day, then you say, sorry to love, man. And then you sold off when the REITs actually got hit by the pandemic.
I remember talking about this with you briefly in a previous capacity, how REITs have suffered so badly from the pandemic. I guess it's good to see them coming back up. Slowly but surely, they'll get there, and hopefully 2024 will be a better year for all of us, not just REITs.
Yes.
Gabriel, thank you so much for coming on Money Talks. It has been so much fun.
Thanks for having me, Andrea.
And as always, a big thank you to you, listener. If you found this episode especially helpful, we want to know. We're streaming on Apple Podcasts and Spotify. We're also up on YouTube now. So if you have the time, leave us a rating, and of course, your comments. We'll be watching. For Money Talks, the team is Joanne Chan, Tiffany Ang, Crispina Robert, Saya Wint, and I'm Andrea Heng.